Thursday. We love to have you every week with us. So today we have a very special guest with us, James Wenzel. But before we bring our guest of honor on, I have a few slides to share with you about who Quest is, what we do, who we are, and some events coming up that I know that you will all be excited to join us for. So let me just start this from the beginning for you, switch this up. There we go. All right. So thanks so much for joining us. So who is Quest? What do we do anyway? So we are a self-directed IRA custodian here out of Houston, Texas, with offices in Austin and Dallas. We were started by two brothers, Quincy and Nathan Long. We are started by investors for investors. They were actually self-directed investors themselves, looking for a custodial company to meet their needs. So they went ahead and built one, built around the client experience. And so here we are. So now we have 20,000 active investors all around the country. So no matter where you're joining us from, we can help you. We now have $2.1 billion with a B under administration and $400 million in undirected cash to help you fund those projects. So make sure you're getting in touch with us about that. Of course, our disclaimer, Quest Trust Company, we do not provide any tax, legal, investment, structuring, or any other sort of advice or endorse any products, services, or investments, people, etc. This presentation is for educational purposes only. Of course, we encourage you to do your due diligence on all of the people and investments that you are doing. Make sure you're getting in touch with your CPAs, your attorneys, your tax advisors before entering into any investments. All right. So what is a self-directed IRA and why should you have one? So self-directed is honestly just a marketing term, and it means you're in charge. You get to direct the investments yourself, and you get to tell us what you want in the account. So that's really an IRA here is not regulated differently than one at another house. Here at Quest, we hold private assets only. So things like real estate, promissory notes, etc. So nothing, traded in the market. So because of that, that does give us some additional benefits like diversification. So opposed to just being able to be in the market publicly, stocks, bonds, mutual funds. Now we have this open architecture platform where you can invest in these private assets, giving you further diversification in your retirement portfolio. The tax savings, we have tax deferred accounts, and we have some really special accounts like the Roth account or an education or a health savings account where you can actually get some of those funds out tax free. Make sure you're getting in touch with your IRA specialist to see how you can do that. Social investing, not everybody can get traditional financing. So, maybe doing like a financed home for someone out of your IRA or loaning someone funds out of your IRA will help them get a house that they wouldn't be able to get otherwise, or funding, a contractor's project, improving your community around you. So that's really something unique that you can do in a private asset as opposed to publicly. And of course, you get to use your education, invest in what you know best. So if you're really knowledgeable about these sort of assets, this is where you really get to put that education to use in helping yourself save for retirement. So here are the 7 types of accounts we have here at Quest Trust Company. Our personal plans, employer plans, specialty plans. I'd love to tell you all about them right now, but unfortunately we just don't have the time. So make sure you call your IRA specialist. Myself and anyone else in our team would be happy to help you. Get in touch with us and we'll let you know. Even if you're a current client, you kind of already have some of these plans, maybe some other ones could be a good add-on for you too. All right, so here are our typical asset asset classes that our clients invest in. But this is not an exhaustive list at all. Oil and gas investments are certainly a choice, mineral interest, royalties, things like that. So make sure you're getting in touch with us, do some exploring and see what may be a possibility for you. Our client portal, we're so proud of this. We're improving it constantly to give you a better client experience all the time. Pay your expenses, your expense pay, save that $5 on an ACH or check by doing that. Upload your documents, submit fair market valuation, and of course, the investment hub. So get rid of those DOIs and sending forms back and forth. Do all of your investments on the client portal, much faster in everything. So make sure you're checking that out. Endless education, of course, some of the things that make Quest different than the other custodians. Whoops. We love, of course, the classes that we're doing now, the Tuesday, Thursday, Saturday classes. We love to bring our guests in here to share the education with you. Our Citrus Social. So we are starting to do some in-person events. So Houston, first Tuesday of the month, Austin, second Tuesday of the month, and Dallas is going to be the third Tuesday of the month. These are all at 6:30 Central. These are limited to about 50 people. So make sure that you are signing up, registering for these. And if you can't make it at the last minute, no big deal. Just make sure you cancel so somebody else can come in your place. These are hybrid events, so you can attend virtually as well. We do have an education component to this. We also have other vendors and, of course, yummy food for you if you come in person. So make sure to sign up for these as well. Oh, there's our additional classes I was looking for. So, of course, our weekly classes, our virtual networking happy hour for those of us not in the Texas area. This is a great event. Connect with other investors all across the country. We typically get coast to coast. Last time we had California, New York, Florida, of course, everything in between. We even had someone from Canada who only does business in the US. So great place to meet other people, see how other people are doing their investments. So come join us, sign up for that. And of course, YouTube, Facebook, this webinar right now is streaming live on YouTube on our channel. All of our other webinars are also on there under the video section. So make sure to check that out as well. And our event, QuestCon Live, is coming back December 3rd and 4th. So make sure to sign up for that. Early bird pricing is still on there now. If you would like a free ticket to this this event, let me know. I can show you how to do that. If you open up a new account, you automatically get a free ticket. If you're a current client, we can sign you up for a free ticket as well. So let me know if you'd like one of those. We'll help you out. How to get in touch with us. We are so easy to get in touch with us. You can go ahead and use that QR code. Chat with us live on our website. It really is manned by us and not a robot. We get that all the time. It is myself and the other IRA specialist, our transaction specialist. We're happy to help you through the chat. It is manned during our office hours, 8:30 to 5:30, Monday through Friday. Give us a call. I love our phone number, 855-FUN-IRAs. We really do make this easy and fun for you. Or, of course, you can email us directly, iraspecialist@questtrust.com, or you can email me specifically. We are happy to help you. All right, quite enough from me. I know that you really came here to hear from James and his topic of commercial real estate and a passive investment. So, James, take it away for us.
Awesome.
Thanks for being here with us.
No problem. I'm going to share my screen. Thank you for having me.
Thank you.
All right, let me share here. And are we good? Can you see my screen? Whoops.
All good, sir.
All right, let me go back here. Well, good afternoon, everybody. My name is James Wenzel with FLW Capital. Thank you, Nicole, for having me today on your Quest Lunch and Learn. And today we're going to be talking about how to analyze a commercial real estate deal as a passive investor. And, you know, the content that's in here, and we can talk weeks about education and training on how to analyze a deal. It takes, you know, weeks worth of courses, but I'm going to try to condense it within a 20-minute, 30-minute presentation so you can walk away with ways to analyze deals to minimize mistakes in the future. Because it truthfully takes years to analyze and learn how to really make the best decisions and pick the best commercial real estate assets. So that's what we're going to kind of talk about today, is how to analyze a deal as a passive investor. So a little bit about myself. I've been investing in commercial real estate and in real estate for the last 10 years, lots of education courses. I've invested with self-directed IRAs like Quest, as well as cash. I've invested with 7 different syndicators and have invested in 15 plus commercial real estate syndications in 5 different metro markets. And the types of deals that I've invested in are B and C apartments, A-class, yield plays, deep value adds, developments, so hotels, so a lot of different diversity in the types of commercial real estate that I've invested in. My personal favorite is I like to invest in apartments B and C class workforce housing because that really focuses on the masses. There's a big tenant pool, and I typically put about 80% of my capital into those types of investments because in my opinion, they have the best risk versus return benefit, as well as I really like cash flow. I mean, who doesn't like cash flow? Now, here are some of the reasons why I do passively invest for some of your newbies out there. It is passive, which means that someone else is doing all the day-to-day operations and you're benefiting from their expertise. I really like the leverage aspect of passively investing because you're leveraging other people's expertise, other individuals' experience, as well as pulling other people's money together in these syndications so you can buy bigger projects and get those larger returns. And then, of course, stability with inflation kicking in, with all the economic turmoil and fluctuations that are going on. Real estate has always outperformed the traditional mutual fund investment model. And plus, you can actually touch, feel, and see the property that you're a part of. And then, of course, the three that is focused on us as individuals is that cash flow, that net worth building, that the tax advantages that you had. And Nicole did touch on some of those. And regarding the tax advantages, you do share in the depreciation of the asset. So typically, when you're invested in these types of deals, you get a K1, and the benefit of that is going to be dependent on what your CPA says. So make sure you talk to your CPA on how you can benefit from those tax advantages. So what that kind of looks like is that you're not going to pay too much taxes on this income. Some people don't pay any, but once again, that's going to be with where you're at income-wise, what your W-2 job is, or if you're a full-time investor. Moving on, now we're going to get into the presentation itself. Today, we're going to be talking about, in order to understand how to evaluate a deal, you need to know what type of investor you are. So we're going to talk briefly about being accredited versus a sophisticated investor. Then we're going to talk about the types of deals that are out there and risk levels associated with each one of those deals briefly. Then we're going to talk about what to evaluate. And like I said, that's weeks of training and years of experience to really learn. So I'm going to try to just pull out 5 or 6 of the things that I really focus on that I've learned over the last number of years to help you all minimize potential mistakes and also help you decide what types of deals you want to invest in. And so we're going to talk a little bit about underwriting. And the key point of that is, are these syndicators that you're investing with, are they conservative, moderate, or aggressive in their underwriting modeling? And that's very, very important. Then we're going to talk entry cap versus exit cap. We're going to talk about sub-market analysis metrics and what the averages, norms, occupancy, rents, et cetera, what that means when you're analyzing these particular deals. We're going to look at an example offering. And then, of course, we're going to talk about the lead syndication team and how it's important and how to select if those are the people you want to invest with. So starting off with accredited versus sophisticated investor. An accredited investor is someone that can invest in both 506B and 506C offerings. It's an individual with more than $200,000 of annual income at least 2 years. It's a married couple with more than $300,000. And of course, having more than $1 million in assets as a household. And then, of course, if you have certain certifications and you're part of a financial institution, that is also can get you as an accredited investor. And then if you have a trust, it's got to be more than $5 million in assets. And these accredited investors can both invest in 506B offerings as well as 506C offerings. Now, a sophisticated investor doesn't meet that criteria, but they have some sort of education. They know about the investment market, and they can invest only in a 506B offering, which allows for both accredited and a maximum of 35 sophisticated investors. And in order to invest in a 506B offering, you have to have a pre-existing relationship with the syndication team or the lead investor. Now we're going to jump into the types of deals. Now, keep in mind, this is my opinion on what I feel has a lower risk profile, versus a higher risk. So starting at the top, we're starting at the top right here. We're going to talk about the apartment yield play. And I really like this type of investment because it is a already cash flowing asset. It's already stabilized at 90% plus occupancy. Everything's already been done. It's clean, it's fresh. It could be an A-class property. But the reason I like that, once again, is that cash flow. And you usually get anywhere from 7 to 12% cash flow on an annual basis. And typically that's a longer hold. So your money will be tied up. But the nice thing about it is that it is cash flowing and it's already fixed up. So you're not going to have to worry about any major capital expenditures or running into any issues. You shouldn't have to run into any issues with that type of deal. The next one, which is an apartment value add, that happens to be, once again, my personal favorite because you get the benefits of the cash flow like the apartment yield play, but there's also a backside of a value add bonus that you could potentially get at the end of the deal. Typical hold on these types of properties are anywhere from 3 to 6 years, where you can pretty much, in most of the deals that I'm invested in, and once again, these aren't promises, these are projections, you can usually double your money right around that 5-year time frame. And once again, I love that cash flow. You can also get typically a 7% preferred return throughout the life cycle of that deal. Moving down the line is mobile home parks. Those are, once again, that's also workforce housing like the two above. That's all workforce housing in those categories. What I like about the mobile home parks is that you do get cash flow during that time. And typically that can range anywhere from 7 to 15%. But you have to be really careful on what type of mobile home park syndication you're investing in because there's different types. You got the mobile home parks where they just own the land and they lease that land to tenants and the tenants purchase the property that is on site. So they actually own the mobile home units. They lease them out, whatever it is, but they actually own it. The tenants do. And then the other type is where the syndicator actually owns everything, including the units. I try to stay away from that second type where they own the units just because those units get run down and they eventually, you pretty much have to throw them away or get rid of them and you paid more than what you got. So, but still a very nice cash flowing asset. And those top three, the apartment yield play, value add, and the mobile home parks, those are all workforce housing. Next on the category is self-storage. I like self-storage, great cash flow. Anyway, once again, anywhere from 7 to 12%. And that's usually consistent cash flow. You'll see a lot of that offered in terms of like funds where you invest in multiple self-storage units. And like I said, I do like that, but, and with, with inflation kicking in, with house prices going up more, I see that picking up. And I see a lot more offerings in that arena because you're going to have families that are moving in together due to housing constraints, and they're going to need to store their stuff somewhere. So that's a great market. But once again, you have to be careful because if you have a storage unit here and someone puts one right next door, they could siphon away some of that business. The next on the scale is the apartment deep value add. I do invest in some of these deals. Once again, 80% goes into these top four categories, the workforce housing, and the rest, other 20% that I invest goes into these. That's just my personal investment breakdown. But the apartment deep value add, I love that project. The only problem with this is you will not see any cash flow. You will not see any returns for the first three to maybe even the end of the deal before you see anything. But the potential to make great returns are really high. But with the potential for great returns also comes potential for great risk because, something can go wrong. Lumber prices can go up, or they open up a building that they're trying to fix. Something might be behind the walls that you didn't see. So there's just a lot of risk. Most of the time they factor in for that. And once again, great opportunity, and returns are typically doubling your money maybe every 3 to 5 years. So another great option. Hotels are next. I've invested in some hotels. You just have to make sure, like what happened with COVID. With COVID, there's a lot of the hotel business did not go very well. Right now, though, might be a good time because hotels are ramping up again. So if you are going to invest in that, I would just look to maybe invest in hotels that are in high vacationing tourist areas. Otherwise, I typically try to avoid hotels unless they're in those vacation areas. Next is retail centers, and I'm going to lump that together with medical office buildings. Those are also good investments, but I typically don't do too many of those just because what happened with COVID. Once again, I was driving down in a very nice area of San Antonio where I'm from, and in that area, usually it's pretty much a full retail center, but due to COVID, it's about half full right now. And with a lot of the doctors in the medical office buildings going to virtual, I'm not sure how that's going to pan out in the near future for individuals trying to save costs. And then finally, developments that can be apartment developments, retail center developments, medical office building developments. A lot of the projections are based on a lot of speculative data. They do their best to match that up. But look what happened once again with lumber prices this year. So if you projected a certain return for your investors in 5 years when the project's done, but lumber prices jumped up and your projections were not based on that, your returns will be constrained with that type of investment. So with the reward also comes a lot of risk. So once again, top to bottom, lower risk at the top, higher risk at the bottom. And once again, this is my opinion. A good way, if you look at that last bullet at the bottom, location can really help you hedge your risk. So if you buy in a nice growing population, actually, we're going to talk about that right now. One of the first things I do look at is I look at location when I'm investing. And you always hear the term location, location, location. That's not a lie when it comes to commercial real estate investing. You really got to pick an area that is landlord friendly. Not trying to get political here, but red versus blue state. That's very, very important because one law can change your projected returns. I mean, even in Texas, there's a difference between San Antonio and Austin, where Austin, they're not allowing you to evict tenants that are not paying their rent, but in San Antonio, they are if they're not impacted by COVID. So there's just a difference within the literal locality of the law. So you really just have to make sure you do your research on that because one law can impact how easy it is to run your business. You also want to make sure that area is having population growth and job growth. Now, regarding population, you can look at the U-Haul statistics. Areas that I like to invest in are Texas, San Antonio, Houston, Dallas, some of the secondary markets like Longview, Tyler area. Love Florida, love the Carolinas, Phoenix, Arizona area, as well as Georgia. Those seem to be really, really hot markets right now. And then finally, that last bullet is you kind of need to know what the favorable submarket metrics are. So if you're picking a city, make sure that it has favorable submarket metrics like California, New York, the Northeast. Their metrics are not looking good. So I don't care how good the returns look. I'm not going to take that chance because there's plenty of deals out there that you can invest in that are getting similar returns in favorable growth submarket metrics. All right. So now this is an example offering. And the reason why I'm showing this now is because the numbers look really, really good. This is actually one of our older offerings that we had early in April. This is a workforce housing project in San Antonio in a very, very good submarket. Projected returns were 15 to 18% for the annualized rate of return. The equity multiple was 1.75 to 1.9. So what that means, if you put 100,000 in that deal at that target time of 5 years, you're going to make 175 to 190 back at the end of that life cycle for 5 years. And then, of course, you're going to notice that since this is workforce housing, it is already stabilized. So you will get a 7% preferred return. Then you're going to see the minimum investment. And you'll see this on Facebook or any of the other syndicator sites when they're advertising. Typically, when they're advertised, that's a 506C offering, and you have to be accredited for that one. But this particular deal, if you look right here, is a 506B offering, which is open to both accredited and non-accredited. Now, if you look right here, just to continue the breakdown of this property, it's 139 units. It is a value add Class B property. There are 112 units that need to be renovated, and it has the lowest Class B rents in the submarket. So face value, this looks like an amazing project, and you'll get a lot of these deals sent to you. But how do you know these numbers are true, or how do you know the syndicator either looked at it conservatively, moderately, or aggressively? And that's what we're going to talk about on this next slide. So when I'm looking, this is something, like I said, this is stuff that I picked up over the last 10 years investing in commercial real estate and going to courses. And for the sake of keeping things simple, we're going to talk workforce housing type projects, because it's a little different for developments. It's a little different for different areas, hotels, but we're going to focus strictly on workforce housing, which is, once again, my personal favorite. And the first thing I look at is exit cap versus entry cap. And regarding the values, commercial real estate values are not based on comparables, what properties are selling for, like the single family market. It's based on net operating income and what that cap rate is. For the sake of what y'all need to know regarding exit cap and entry cap is you need to know that the lower the value, the more valuable the property is, the lower the number. So if you get closer to 1, it's going to be a higher value. If you get closer to 10 and moving your way up to 10, that value decreases. And so the bottom line, when you're looking at exit cap versus entry cap, on the 2 most recent conferences I went to, they recommended increasing by 0.01 per year. So if it's a 5-year hold, it needs to be 0.05 per year devaluation of that cap rate. So if you look down at the slide below, right here, you'll notice that these 2 properties are the exact same property. They're the exact same numbers in this area. This is the same as this. But you'll notice the returns are significantly different. And why is that? If the numbers are the same, everything looks, all the numbers, all the metrics are the same. The only thing that's different is the exit cap rate on each one of these deals. So this is why that's the first question I ask a syndicator when I'm investing in their deal is, what's your exit cap versus entry cap? So if you look at the top graph, you'll notice right here, the going in cap is a 5.5. And this is a 5-year project. And you notice right there, the exit cap is 6. So you move up 0.1 per year. So you get nice, solid returns that are very conservatively estimated. And so your returns are not based on the appreciation of the property. Your returns are based off of the value add that the lead team is putting into that property. And we'll get into value add in a second, what that means. So once again, this is more of a moderate to conservative estimate, but the bottom graph is a very aggressive estimate on the returns. They actually went directly the opposite direction, where they went from a 5.5 to a 5. So they actually went, if you go directly the opposite direction, you could see how it significantly boosts your returns. So you just have to know, to be safe, exit cap needs to be devalued by 0.1 per year in a BC apartment workforce housing property in the San Antonio or Texas market, just to be safe. Now, the second thing I look for is cash flow. That is very, very important. I think I've said cash flow probably 100 times here, but you'll notice this particular property, because it is a value add property, it's already stabilized. It's already cash flowing from 8.21 all the way to 12.71. So I really like that. And I typically try to avoid properties in these value add categories that are not cash flowing more than 6% in their metrics. So for me, my cutoff is if it's less than 6%, I won't do it. Maybe for the first year, if it's less than 6%, I'll get away, but at least year 2 and beyond, it needs to be beyond that. Now, if you're getting a 7% preferred return on a deal, you just need to make sure that this number is greater than that 7% preferred return. Now, the next thing I really evaluate and dive into is the comparable submarket metrics. And that includes things like rent growth, occupancy, neighboring properties. And I underlined rent growth because this is another area where a lot of people are overinflating or manipulating their data. So if the average rent growth, for example, in San Antonio is at a 4% rent growth, but in the underwriting model, they're putting an 8% rent growth, you know they're manipulating that data. It needs to be more closer toward that 4% rent growth. So when you're looking at that, once again, you're just making sure their analytics are matching up with the comparable submarkets. So anything out of whack might be an issue. Same thing for occupancy. If the average occupancy in that submarket is 95% and they're saying 100% occupancy, there's an issue. Or if it's 90% and they're saying they're going to go up to 100%, once again, you just have to know what that comparable submarket metric is. And you can ask them because they do have the CoStar reports for these offerings. The next thing I evaluate is the value add upside for a property. Very, very important. And if you look on the last slide, this particular one says at the bottom that 112 units need to be renovated out of the 139. So you know that that's a great opportunity for driving up value because there's a ton of units that need to be renovated. And with better renovated units becomes better rents. And then down here, you can also see that they have the lowest Class B rents in the submarket. That probably has to deal with the units not being renovated, but you know there is a lot of value add upside in this particular property. So just keep in mind, you can ask that question. I'll get to the questions in a second. And then finally, the last thing I really look at is break-even occupancy. So if the average rents in that submarket are 90% and the break-even occupancy is at 88%, you know, that's a little tight for me. Most of the deals I get into, average occupancy is about 90% and break-even is anywhere from like 65 to 75%. So you got a nice cushion if something happens where they're not going to be losing money on the property, even if something happens. So bottom line of this page is, are the syndicators evaluating the data aggressively, moderately, or conservatively? The bottom, very aggressive. The top graph is more moderate to conservative. Now, here are some example questions you can ask the syndicators regarding their underwriting, and I typically ask these questions. My first one is, what is the exit cap versus the entry cap? If they are going downward on that exit cap, increasing the value, I typically walk away from that type of deal. If they are, devaluing the property, I like those types of underwriters because they're a lot more conservative. The next question is, what is the cash on cash return? And once again, I like everything above 7% if you're doing a value add. And what is your organic rent growth projections versus the actual rent growth for the submarket? So once again, if you're at 3% rent growth in a market and they're projecting at 8%, yeah, that's a pretty big discrepancy. Next question is, what is your break-even occupancy? And then finally, what are your value add initiatives for your project? And then when you're finally looking at the syndication team, you also need to eval. I'm going to shrink this so I can read that side of the screen. Sorry, the faces were covering it up. The underwriting history, if they're conservative, moderate, or aggressive. What is their historical performance versus projections? What types of offerings that they're buying? Are they buying developments, hotels, A, B, C, D, apartment complexes, hybrid, yield plays, deep value add? Is it 506B if you're a sophisticated investor? And so you need to know, because if you only want to invest in certain things, you don't want to be flooding your emails with deals if you're not even interested in those particular types of deals. You also need to understand their experience in the market that they live in, that they're purchasing in. If they're a California company and they never step foot in San Antonio, you probably don't want to be investing in that deal that they're buying in San Antonio. But if they have boots on the ground, there's someone on their team that has experience in that market, that's fine. And then my biggest pet peeve is that responsiveness factor. If you are sending emails, asking questions, and they're not responding, that should be a significant negative signal. Now, sometimes they might be traveling or they're at a conference and they might have just missed your email. They'll typically respond back and say, oh, I was at a conference or I was traveling. But the reality is, if you ask multiple questions and they're not responding, just drop them. There's plenty of apartment syndicators out there where you can invest in those deals. So just keep meeting people and doing that stuff. And then finally, the people, do you trust them? Do you know them? Do you trust them? Do you like them? Because you never want to be tying up big chunks of money, 25, 50, 75, $100,000 with people if you don't like them and if you don't trust them. And then, so today we talked about how to evaluate a passive investment offering as a passive investor. We talked about accredited versus sophisticated investors, types of deals and the risk associated with some of those, how important location is when you're investing in these deals, how to evaluate underwriting by looking at things like entry cap versus exit cap, cash on cash return, utilizing these sub-market metrics to make sure the underwriting is conservative, like rent growth, occupancy, break-even occupancy, cash flow. We looked at an example offering numbers and how that could easily be manipulated by just changing some of those metrics like the cap rate. We talked about the importance of understanding the lead team. And then we talked, and one final bullet is best practice. Just get deal flow, get on syndicators lists, reach out to them, learn from them, ask them questions, go to conferences, communicate with them on email. And the more deal flow you get, the more deal flow opportunity, more opportunity you're going to have to be able to compare deals and diversify your commercial real estate portfolio. And most of the time, you're probably going to stick to certain syndicators just because you trust them. But every once in a while, you're going to see another deal that you just can't pass up in a city maybe you're connected to or something like that. I got a buddy that lives up in Montana, and he likes to just buy a ton of Montana deals because he lives there. But that's all I got. So I guess I'll pass it back to Quest. I'm going to stop sharing my screen here. Are there any questions? Oops. Let's see.
Hello.
Hello, Nicole.
Hello. All right. We do have a couple questions.
Let me write these down so I can keep track of them and answer them properly.
Awesome.
So what do we got?
All right. So we kind of already talked about it, but just maybe a little summary of maybe some quick, like the best metrics to maybe go by when kind of like evaluating these deals.
Right. My number one is the cap rate. That is where you see most of the manipulation, the exit cap rate versus the entry cap rate. That's my number one. That is where I see most of the manipulation going on right now. I was actually at a conference up in Dallas recently, and one of my friends was asking me, my passive investor buddies was asking me, how do I evaluate a deal? And I go, the first question I ask is this. And he's like, I've never asked that question. I'm taking their numbers for face value. And so he actually went up to a couple syndicators that were at that conference. And there was one syndicator, I'm not going to name any names or bad talk anyone, that had a 7% entry cap rate and his exit was a 5. And they were barely hitting 70% annualized return. And that particular submarket, because I looked it up while I was sitting with them, was at a 6% cap rate, is what the going market was. So what was happening was the syndicator was compressing their returns in order to get returns so people would invest with them. So you really have to watch out for that. So exit cap needs to be devalued compared to the entry cap in these particular apartments by 0.1 per year.
Perfect. Awesome. Thank you so much for that. Okay. The other one was for someone like just starting out, what is something that they should like really look for? Maybe some like key tips for newbies, if you will.
Well, jumping on a call like today, that's super important. Education is the number one thing. I have spent probably more money than I should have on how to evaluate deals and passive investing. Like I said, what I pulled out today was from years of experience and courses, and I'm just pulling out 5 or 6 of the things that I would look at to keep things simplified, because there's a lot more things to look at. But education is the number one thing for a newbie. Talk to syndicators when you're going to these conferences and meeting them, or emailing and getting on their list to passively invest with. Now, for example, you go to FLWcapital.com and you reach out to us, we're going to call you back and talk to you about your investment goals and what you're looking at. And then find out if it's a right fit in our type of investments. But that's what most of the syndicators do. That's a way to get educated, because we primarily focus in San Antonio area. And we particularly focus on that workforce housing because that's what I'm passionate about. All my passive deals before we started syndicating deals were in that workforce housing, and the other 20% were in other areas.
Awesome. And of course, here at Quest, we think education is so important too. We think, of course, the best investors are educated investors so they can make those really good decisions for themselves. We have a question, another one that just came in. What sources do you find for reputable syndicators?
Well, there are so many syndicators out there. Some of you probably have on your Facebook feed. If you're as old as mine, it's Facebook. For the younger people, it's Instagram. But on your feed,
on Facebook.
Oh yeah, I'm Facebook. Yeah. So, or I joke with my daughters and call it the Snapgram and InstaChat. And they,
I like that.
But the best thing to do is well, for me, I hate to say this, I evaluate the deal first.
Okay.
I evaluate the deal number one, because if the deal underwrites, because banks are not going to be loaning money to these individuals. So I look at if someone sends me a deal, even if I haven't invested with them, I look at the deal first. And then if the deal pencils out and they're conservative on their estimates, it's in a great location, I am going to move over to, then I'm going to look at the team, because you could like someone and you're friends with them and it's great. But if you evaluate their deal and it doesn't meet the metrics that I'm talking about, then I don't care how good of a friend you are. I'm not going to be putting my money in that deal if it doesn't meet my certain criteria. So I always look at, and you can always tell if a deal is really, really good in these apartment communities if the leverage is really high on the bank loan. And that was another question that I could have put in there. I just didn't want to complicate things.
No.
The bank's willing to give, 75, 80 plus, 75, 80% leverage on that deal, that's a strong performing asset for a cash flowing asset. If they're getting down in the 50s and 60s on leverage, that means that it's a lot more of a risky type asset. So the lower the leverage that the bank's giving, the lower that they saw on the underwriting. And so once again, as far as how do you interview syndicators, you just go to conferences, go to local meetups. They have meetups all throughout. If you just go to Meetup app and type in multifamily, you'll see a lot. I go to, in Central Texas, I go to the ones over in Austin. I go to the ones in San Antonio, Dallas. I go to all these meetups to meet syndicators, but also to be there to meet some future passive investors or people that are interested in investing in our particular product. So going to conferences and then emailing people, like reach out to me on my email site. There's a lot of syndicators out there that you can, like I said, conferences, networking, and then just emailing people that you run into.
Perfect.
And like Dave Frazier right there just put James at FLW Capital, or
he put that in there for you. I saw.
Absolutely.
We were going to make sure it was in
there. Thank you. So you can put it on, email me in the panel.
I'm going to put it here.
What is it? What do the kids call it? LinkedIn bio. You can click on my LinkedIn bio.
Oh, there's so many.
I
can't keep track of all the social, Snapchat and all kinds of stuff. My 9-year-old's like, look what I can do. I'm like, Mom will never figure that out, sweetie. Right. Thanks, though.
So any other questions? Or
yeah, we have a few more.
Let's keep going. Let's speed this up here. I want to answer all of them.
Okay. Here's another one. When you invest into a syndication project, do you need to register to do business in the state the investment is in, or does the syndicator do this for the project?
Ooh, that's a great question. I'm sure there are a couple states. I'm sure there are a few states out there that you might have to register in that state, but usually how the investments are set up, they're set up through a legal entity. And that's why it's a private placement memorandum. So you're purchasing, and Quest will help you with that if you're doing it through your self-directed IRA. But for us, for example, we have a lawyer that sets up the legal entity so people can invest. And a lot of times sometimes they pay to register someone in that particular state. And I think it's only maybe some of those, I hate to say this again, blue states that require that. So I'm not an expert on that answer. That's more of a legal. So far, with all the investors that invested with us or any of the deals that I've done in the past, 10 years, I have not had to register myself investing in that deal. I guess it's kind of like the stock market. When you buy a stock, you're kind of buying a particular asset. You don't have to register wherever that stock you're buying from. It's kind of set up in a similar fashion.
Perfect. I have one more question. Does that work?
Yeah, that's great.
Okay. So what would your last like golden nugget piece of advice for just, I guess, anyone in this kind of or passive arena? I suppose commercial real estate. Yeah. Since we're focused on commercial, what would your like golden nugget piece of advice be to investors in this arena?
Oh goodness. What I tell my personal friends is I tell them, number one, get educated. That's super important.
Perfect.
Whoever's sitting on that call, that's very important to be educated in that arena. So number one, education.
Sorry.
Uh-oh. See, that means yes, education's important.
That does. It's a notification for me.
Oh my gosh. So she emphasized that point. Education's number one, because you have to know how to evaluate these deals. You have to protect yourself by evaluating. I have a lot of friends that actually reach out to me on deals they're looking to invest in. And we actually had a little passive investment club in San Antonio with a pretty good size of group of friends and associates where we did evaluation on syndications, and people would actually pitch these deals to us and we'd invest together. So always education, get a second opinion on your syndication deal, someone that might know what they're doing. Don't be afraid to ask the syndicator questions, because then you can test their responsiveness. So
I like that.
Questions, because you want to see if they're going to respond. At FLW Capital, we pride ourselves on responding. Sometimes you over respond, so we'll spam you with all responses from everyone on the staff. So we don't want to do that, but sometimes we do that because we want to over communicate. And I guess probably the most important takeaway, because I sat on the sidelines for like 5 years, just watching this type of investment model just go through the roof. And I wish I would have started 5 years before. So what I tell all of my associates and all my friends is invest in 2 syndications minimum per year.
Okay.
So, and the reason why I say that is you can find that type of money. So, if you're saving and you've done the Dave Ramsey thing and saved, and now you're cash heavy, don't let your money sit in cash right now, because if you have $1 million sitting on the sidelines, that $1 million in 6 years might be $600,000 because of inflation. Mm-hmm. But if you put that in a hard asset like real estate, that $1 million will be $2 million in 5 years. So you're seeing that, the inverse relation. So do 2 deals per year. So to summarize, I guess 4 key points. Number 1, get educated. Number 2 is I guess, what did I say? Don't be afraid to ask questions.
And make sure the sponsor is responsive.
Yeah. Get deal flow. So make sure you register on these syndicator sites, especially ours, of course. Not trying to do a side note, but we put out some pretty good deals. And then evaluate that deal yourself. That kind of goes along with that second thing. And then do 2 deals a year of syndication. That's super important.
Perfect. Thanks so much.
Next thing you know, you're in 10 deals, and your $1 million went to, $6 million or something like that, depending on the type deals.
Let's hope for those kind of returns.
I know, right? And once again, these are not promises; these are projections, and this is for education only.
Of course. I know that there's going to be people with more questions and more information wanting from you. Do you have a website or a phone number that you would want to share?
Absolutely. I'll send it in the chat right now.
Great.
FLWcapital.com is where you can register at. I'm going to type that in, or you want to type that in for me?
We're saving energy at Quest. There you go.
Oh my gosh, you haven't moved enough. FLWcapital.com. I'm also going to put my email. You already put my email on there. And then I'll put it on
again though. We want to make sure everybody has it.
And I'm putting my cell number on there, so don't be afraid to call. We typically answer our phone. If I don't answer my phone, it's because right now we're wrapping up a cap raise. I will call you back. But
giving out a cell phone, folks. That is big stuff.
So yeah, call my cell phone. We also have 2 other partners on the FLW website, Dave Frazier as well as Mark Lemons, and you're welcome to reach out to them also. But like I said, education, doing 2 deals a year, doing analytics on your own, and reaching out to individuals will really protect you from making mistakes. Because I have made mistakes in the past because I trusted someone without evaluating the deal. So just make sure you do those few things, and you're gonna love this when you start investing in this stuff.
Wonderful. Well, thanks so much for being with us today, James. It was really a really great experience and amazing information. I really appreciate it.
Thanks, Nicole, for having me. I appreciate it. And thank you, everyone else, for taking the time out of your day to join us.
Absolutely. Thanks so much, everybody, for spending your lunch with us. I can't read the name that says I can't see the info, but I am putting my email, or I guess if you can't see the info, you probably can't see what I'm typing. My email is Nicole, NICOLE .Baco, B as in boy, A, C as in cat, O, T as in Tom, @questtrust.com. Or you can call us 281-492-3434. I will send you our info, James's info, whatever you are looking for to, I think it's IT in the chat box. We'd be happy to share whatever info it is you're looking for. We'll be happy to take care of you. So thank you, everyone.
One other thing, Nicole, real quick, because this is super important. If any of you are high W-2 earners or moving companies, it's a great opportunity. I wish I would have done it in my first move, to move your money over to a self-directed IRA company and really use that money. I mean, I'll give you an example. I've been working in corporate America for, worked 25 years, right? And I matched and put my money in, and it grew and it grew and it grew. But by investing in commercial real estate within a 7-year time frame, so think about it, 25 versus 7. So I have a direct correlation of how much that money's grown. I've been able to dwarf that money that was in that 401k because of the returns in commercial real estate. So just keep that in mind. If you are moving companies, or you have a big W-2 or have a big IRA sitting out there somewhere, put it to work for you. I wish I would have done it sooner, because then I wouldn't have to do these WebExes. No, I'm just kidding, because I'd be on the whole time. No, but just take action. 2 deals a year, make the money work for you. But
I love it. Take action now. It's fun to take the classes and get the education, but if you don't do anything with it, it doesn't really do anything for you. So great. I love that action step in there, James.
Awesome, Nicole.
All right, everybody.
Guys and gals.
Well, thanks everybody for being here with us. We will see you. The
recording. Yes.
It is on our YouTube channel right now, and you can go to our YouTube channel. It is under the video section, and of course, you can always reach out to Quest Trust, and we'd be happy to email that to you. And Katie is putting the YouTube link in the chat box for us right now. You can click on that, and it will bring you to the video section on our YouTube channel, where this webinar and all of our other webinars are located. So again, thanks for being with us. Thanks for spending your lunch with us, and we will see you at our next class. Thanks so much, everybody. And thanks so much again, James, for being with us today. Have a wonderful afternoon, and we'll see you next time. Bye, guys.
Bye, guys.